Hello and welcome to this event of the Center on Regulation and Markets at the Brookings Institution. My name is Sanjay Patnaik and I'm the director of the center. It is my real pleasure today to welcome three distinguished speakers from academia who will share their most recent research insights on regulatory responses to climate change. We will have about an hour of presentations and then Q&A with a lot of very engaging audience questions, I hope. First, I would like to introduce our first speaker, Professor Johannes Stroebel, who is the David Loeb Professor of Finance and the Boxer Faculty Fellow at NYU's Stern School of Business. Professor Stroebel conducts research in climate finance, household finance, social network analysis, macroeconomics, and real estate economics. He has won numerous awards and is also a member of the Climate-Related Market Risk Subcommittee at the CFTC. He earned his PhD in economics at Stanford, where he also held the Bradley and Kohlhagen Fellowship at the Stanford Institute for Economic Policy Research. Welcome, Johannes, and thank you so much for being here today.
Thank you so much for having me and for putting together this great event. So I'm going to be spending a bit of time talking about the interactions of climate change and financial markets, a new research field that we've termed climate finance. And the motivation for this research field is that in the past few years, there's been the surge of interest in better understanding the interaction of climate change and financial markets. And what I want to do in today's presentation is just to take stock a little bit about what we've learned from that research efforts, what we still need to know, sort of what are a lot of the open questions we have, and how the insights that we have produced so far affect financial market regulation, both sort of what we've seen already and also prospectively what types of regulations we think we see coming down the road. For those listeners who are interested in sort of a more detailed treatment of some of the topics that I'll only be able to talk to you about briefly, we've recently written a review article in the Annual Review of Financial Economics where we summarize some of these insights in more detail. So the starting point for this research agenda has really been to try and study the extent to which climate risk is already priced in asset markets today. And most people that think about this question start from thinking about classifying assets in terms of their exposures to different types of climate risk. So when you think about the ways in which climate change can affect asset values, there's at least two types of categories of risks you want to think about. One of them is physical risks. These are the physical manifestations of climate change that can affect asset values. Think about rising sea levels or wildfires, etc., that have the ability to affect the valuation of real estate assets and others. And the second category is a whole range of transition risks. So these are risks to asset valuations that come alongside the transition to a low carbon or net zero economy. These could come from regulatory interventions such as potential carbon tax or the like, but they can also come through technological developments, etc. Once you classify assets into these, in terms of their exposure to these different risks, you start realizing that depending on the asset that you look at, the most important risk source varies. So when you, for example, look at real estate assets, like I've done in a paper with Stefano Giglio, Krishna Rao, Matteo Maggiore, and Andreas Weber, you realize that physical risk exposures through things like rising sea levels or wildfires are probably the most important risk category that you would expect to be priced in real estate assets, and also real estate related assets, things like REITs or mortgage-backed securities or other assets where the payoffs depend on an underlying real estate valuation. When you think about equity markets, you can probably find that the largest set of exposures are to transition or regulatory risks through the carbon intensity of firms. For example, you might think that the oil companies are substantially exposed to transition risks in case we're going to get a carbon pricing system somewhere that would harm the relative competitiveness of those firms relative to other energy producers. In the municipal bond market, this is a market way over $1 trillion in the US. You have both physical and transition risks because of the location of the tax base, right? So if you're a municipality borrowing and you're in an area that's going to be exposed to rising sea levels, that's a physical risk to the muni bond market. But also, if you have an economy that's very hydrocarbon dependent, you might see transition risks. And you're going to get the same thinking about sovereign debts, physical risks. Some countries like Bangladesh and Fiji, etc., that have substantial parts of the country lying below the sea level are exposed to physical climate risks. Other countries with very oil-dependent economies like the UAE and Iraq, those sovereign debts will be exposed to transition risk. So you can see that, across essentially all asset classes out there, a combination of these physical and transition risks mean that asset valuations will end up being exposed to climate risks. The next problem is to actually measure these exposures systematically. Now, with something like physical risks, it's a relatively more straightforward effort. What you need, and I say relatively more straightforward, what you need is a combination of being able to geolocate the assets, which is quite easy for real estate assets because they're tied to a specific location. So you kind of have a sense about where in space those assets are located. For equities, it's a little harder, but you can get data on the location of production facilities, etc. And you're going to combine that with models of the physical effects of climate change. So to give you one example, in a recent paper where I studied the pricing of physical climate risks in real estate markets, you kind of combining, the transaction prices for, different properties, some of which, in Miami, some of which, end up lying in flood zones, other ones do not. And you're going to get these sort of models of physical climate risk from providers like NOAA and others out there that will tell you, for example, which properties are likely to be flooded if sea levels rise by 6 feet or more, or something like that. So measuring exposure for physical risks is relatively straightforward from that perspective. Measuring exposures to transition risks, I think, is somewhat harder. And because it depends on a combination of a variety of things, including understanding the business model of firms, not just today, but also about how firms, are planning on adjusting their business models down the road. Think about two oil companies, one of which is doubling down on oil drilling, while one of them is, promising to transition to become a much sort of more renewables focused company. Both of them might have sort of similar carbon emissions today, but their exposure to transition risks is going to be very different. How can you try and measure even, exposures today? Well, some firms disclose information about their carbon intensities. There's also publicly available information on things like ESG scores. And researchers have tried to, become fancy and try to do textual analysis of 10K statements or listening into earnings calls, etc., to try and come up with a measure of which firms are, have business models that are substantially affected by these transition risks. But fundamentally, measuring transition risks has enormous data challenges. And here we come to the first part where I think what we've learned in this research field, I think, has the ability to influence where regulation is going to go into the future. Because any asset manager you talk to basically spends, a lot of time complaining about the fact that they can't measure these risks well. Why? Because the underlying portfolio companies, the underlying companies that they would like to invest in, aren't yet making the disclosures in a systematic and comparable way that would allow, a BlackRock or a Vanguard or whoever it would be to decide which firms are more exposed and which firms are less exposed. And so we're going to see, regulatory action by the SEC in this space, requiring firms to make disclosures in this direction. And we're going to, I think, see this relatively imminently. So here's from a speech by, SEC Chair Gary Gensler in July, where he said, I've asked SEC staff to develop a mandatory climate risk disclosure rule for proposal by the end of the year. So I think we're going to see that over the next weeks. We're actually going to see that sort of proposal to come out. What might such disclosures look like? Going to be an important focus on consistency and comparability, which is going to replace the mishmash of ESG provider scores, etc., that we have today. So I think, financial markets are asking for this type of disclosure, such that they can start managing climate risks in their portfolio. And I think we're going to see regulation that helps with that. The EU is a little bit ahead of the US in this case. And so the EU has introduced the taxonomy, which is a classification system that goes through a whole range of economic activities, classifying them into being environmentally sustainable or not. And it's now building a reporting requirement on top of this taxonomy, which would allow companies, investors, and policymakers, in their own words, with the appropriate definitions for what you can even consider to be environmental sustainable or not. So it's very much a top-down approach of really going through sort of relatively, carefully specified economic activities and deciding, what's sustainable and what's not. That's obviously also potentially problematic, and we're seeing a huge fight right now about whether or not nuclear power should be declared a sustainable business activity or not. That obviously has large implications for countries like France, where nuclear power is big, but countries like Austria are opposing the inclusion of nuclear power as a sustainable business model, as an environmentally sustainable economic activity. But it's an alternative approach to what I think we will see coming out of the SEC, which is going to be focusing largely just on carbon emissions or something like that. But again, what that final proposed rule will look like, I think, is yet to be seen. Okay, so then when you can measure these exposures, there's sort of two approaches you can take to try and assess whether or not these exposures are priced. Right? One of them is what you would want to do is you would want to compare the expected returns or the prices of two different assets that are almost identical, except that one of the assets is more exposed to either physical or transition risk, while the other asset is less exposed. Now, that type of comparison is obviously very hard because energy firms don't just differ from other companies because of their carbon emissions, but they also differ on a whole range of other issues. Similarly, real estate properties that are more exposed to sea level rise are also differing on other dimensions. For example, they're more likely to have a nice beach access. And so this type of just simple comparison between the prices of more or less exposed asset hasn't really led anywhere in the literature. And so what the focus has been of research efforts has been to assess the returns of more or less exposed asset when there's news about climate change or when there's an increase in attention to these type of climate risks. So in a paper with co-authors, we've tried to do this in real estate markets, where we've tried to measure time-varying attention to climate risk in housing markets from the textual description of property listings. In some years, property listings talk a lot about, this property is not in a flood zone, it's high and dry, etc. In other years, they do not. And what we find is that the gap between more or less exposed properties goes up in periods when people pay more attention about climate risk. We find similar results in the equity markets when there's news about climate change that pushes the price movement of more and less exposed firms in opposite directions, again, showing that climate risk is already priced in equity markets. Now, are these risks adequately priced? There's one thing to show that they're priced in a non-zero way, that there's some pricing, but are they adequately priced? Are they fully reflecting the true risks out there? And that's really the research frontier. Honestly, no one really knows. Now, what I've done with some co-authors this summer is we surveyed a large number of academic economists, regulators, and financial market participants. And we just asked them for their perceptions. We asked them in the stock markets most familiar with you, how do prices currently reflect climate-related risks? About 15% didn't have an opinion. 20% said that prices currently accurately reflect climate risks. Only 3% of people said that they over-reflect climate risks. 60% of respondents felt that even today, in the stock markets that they're familiar with, climate risk wasn't fully reflected in prices. Now, that doesn't mean that they're correct, but it gives us a sense of, market participants who are thinking about this every day. What are they expecting prices to do in the future? Because one important aspect, if prices don't currently reflect climate risks, they might have to adjust in the future to reflect these more accurately. But I think this is really an dimension where we need a lot more research. And I think anyone who claims right now to know if prices accurately or not accurately reflect climate risks, is probably overstating their case a little bit. So then when we understand that we have these climate risks, how do we manage or how do we hedge these risks? And I want to think about this question from two different perspectives. The first perspective is that of an individual asset manager. Take a BlackRock or an AQR, or even just a retail investor who's looking at their portfolio, who realizes that climate risk is investment risk and who's thinking about what to do with their portfolios to manage this risk. The second question, and that's obviously important from a regulatory perspective, is that of a prudential regulator, someone like the Fed, who has to ask the question whether climate risk doesn't just present a risk for some firms to lose some money, but whether or not it might even present a risk for financial stability. Now, how would a mutual fund manager or an asset manager, how would they go about hedging climate risk? It's actually not obvious. It's quite difficult. Why? Because we really don't have a whole range of good insurance or derivatives contracts at the moment. There's a whole range of reasons why these markets don't yet exist, and I'm happy to discuss those in the Q&A if you're interested. But I think one important thing to just point out is that my personal view is that derivatives markets will play a very important role in the transfer of climate risks from people that are worried about these risks to people that are more easily able to bear those risks. And the CFTC under Chairman Benham has taken a whole range of steps in this direction. In March, he put together a group focusing on the derivatives market role in addressing climate-related risk. And the idea of this group is, and I've highlighted here, is to accelerate early CFTC engagement in support of industry-led and market-driven processes in the climate and larger ESG space. So as always, innovation is not going to come from the government. It's not going to come from the regulator. It's going to come from the private market. There's a lot of demand for these types of new financial instruments that might allow the transfer and sharing of climate risks. But it's great to see that regulators are aware that they need to play a big role. They need to create the regulatory environment that allows this type of financial innovation to happen, because there's certainly a lot of need for it. So then in the absence of large specialized assets that allow us to hedge and transfer climate risk, there's a research agenda that I've worked on with a number of co-authors to try and see what can we do in terms of thinking about portfolios that might allow you to hedge these risks using publicly traded assets. So rather than sort of specialized derivatives contracts, trying to say what can we do by just looking at, say, the universe of investable stocks in the US. And so we have a first paper where we said, look, if you want to construct a long-run hedge against climate risk, this can be replaced by dynamically hedging news about climate change. So if you can construct a portfolio that does well every time we get bad news about climate change, then sort of cumulatively, this portfolio will do very well if climate change gets very bad, and will therefore have this hedge portfolio. Now, how do you go about measuring news about climate change? So we have a bunch of approaches using textual or sentiment analysis of newspaper coverage, etc. It's not worth going into the details, but heuristically, you can think about every time the Wall Street Journal presents it to its readers some bad news about climate change, you're looking for a portfolio that does relatively well in those periods. Now, how do you put together a portfolio like that? Well, there's a bunch of approaches you can take. One of them is what we call a narrative approach. So you basically take an ex-ante view on which businesses will do well and which businesses will do badly when we get news about the increased likelihood of, say, some of these transition risks. And here we're back in the other, in the problem we had before. You can try and do this on e-scores. So you can go long the green firms and you go short the brown firms, right? And so you would think, well, green firms should do well when we get bad news about climate change, because it makes a regulation more likely, and that regulation should help the green firms. But we're left with the low quality of these exposure measures, which hopefully will be solved by some of these disclosure requirements. But so far, this is not working very well. The alternative is to use what finance economists call a mimicking portfolio approach, which is to regress news on asset returns in the past. So I'm basically trying to see, well, I can look at this climate news series that I want to hedge in the past, and I can try and see which stocks did well in the past when we saw news, and then I'm going to assume that those stocks will continue to do well going forward. The problem with this approach is that we only have very short time series. So, this type of approach suffers from an overfitting problem where we have many, many more stocks than we have time periods in the past where we think climate risk was priced. And so this approach doesn't work. So one new approach that I've been working on with some co-authors is we call the quantity-based approach. And the quantity-based approach starts from the insight that comes from the science literature. So this is not something that financial economists have worked on, that realizes that local extreme heat events shift local attention and local climate change beliefs. So, if Seattle has just lived through an extreme heat waves, there's strong evidence that people living in Seattle now worry more about climate change and they believe more in climate change. And so what we ask is trying to figure out what industries or what stocks do mutual fund managers disproportionately buy and sell after experiencing one of these local extreme heat shocks. And then we'll try and see if we can form long-short portfolios on these industries. And what we find is that if we do that, those quantity-based hedge portfolios substantially outperform other approaches that people have used, the narrative approach, or say the mimicking portfolio approach that I've just talked about, to try and figure out how to hedge these climate risks. Lastly, we want to ask, not just from an individual investor's perspective, but now put yourself in the perspective of a banking supervisor, right? Who's trying to not figure out, well, can some investor lose some money when climate change materializes, which is an important question for the investment community, but doesn't itself have to be a systemic financial problem. In order to answer that question, does climate risk affect bank health and financial stability? You need to answer a bunch of questions. Who holds physical and transition climate risks eventually? How do bank loan portfolios change in value alongside reasonable paths of climate change? And so we have a bunch of approaches here, that we call stress testing or scenario analysis, where we're trying to figure out, how do bank portfolios develop under some assumptions about, the path of climate change. Now, there's obviously an important question here about which types of scenarios would you consider. But I think we're going to see more of this type of behavior going forward. In Europe, this is already happening. So the ECB has been, for example, telling banks to map climate risk into their trading and loan books. in a sort of stress testing style scenario. And we're going to, we had an economy-wide stress test in the EU that the ECB conducted this year. And from next year onwards, we're going to see climate stress tests of bank portfolios going forward in the EU. In the US, I think this is going to move slower. So, we're still in the space where, the Fed governor anticipates new guidance on climate change for big banks. I think we'll see some activity here, but I think it'll take a while before, the types of stress testing that we're doing in Europe is going to play a role in the US also, in particular, because I think in Europe very quickly, these types of, learnings from these climate stress tests will start affecting capital requirements for banks, etc. I think that's something that we're probably, a way away in the US and may never get there. So overall, I think climate finance, this studying of the interactions of climate change in financial markets, is a really exciting field with lots of open and interesting questions. We have a lot of regulatory bodies, economic regulatory bodies. We talked about the SEC today. We talked about the CFTC today. We talked about the various banking supervisors, all thinking about this, all trying to make sense of this. I think we've made some progress. We now understand that climate risk affects asset values. We've made some progress in terms of how to mitigate, how to share this type of risk. And I think we need to make a lot more progress on the disclosure side, so we have better data. And then eventually, we need to make a lot more progress trying to understand not just if this is an investment risk, but if this is a large enough investment risk that it also presents a financial stability risk. And I'm going to end right here. Thank you very much for listening.
Wonderful. Thank you so much, Johannes. Very interesting. And I think climate risk is really one of the biggest issues that we're facing today. And a lot of companies and governments ought to think about it. Great. So our second speaker is Professor Meredith Fowlie, who is a professor in the Department of Agriculture and Resource Economics and holds the class of 1935 endowed chair in energy at UC Berkeley. She's a faculty director at the Energy Institute at Haas, and she also has a research associate at the National Bureau of Economic Research, where she co-directs the Environmental and Energy Economics program. Professor Fowlie has worked extensively on the economics of energy markets and the environment, and her research investigates market-based environmental regulations, the economics of air pollution, electricity market regulation, and incomplete greenhouse gas regulations. She also currently serves as a governor-appointed member of California's Independent Emissions Market Advisory Committee, and she will talk today about electricity sector regulation and how we can facilitate the clean energy transition. Thank you so much for being here today. I give it over to you, Meredith. Welcome.
Thank you. And thanks for the invitation. It's a real honor to be here, especially with Johannes and Simone. Johannes is a difficult act to follow, but I'll try. So how I'm going to use my 20 minutes, when you think about the regulatory response to the challenges posed by climate change, I think the first types of regulations that come to mind are some of the regulations Simone is going to talk about: carbon pricing and direct emissions regulation. I think increasingly we're thinking about financial market regulation, some of the interventions that Johannes was talking about. What might not be top of mind is good old-fashioned natural monopoly regulation. We don't usually think about this as like a key lever we have, but I'm going to try and change that thinking because I think it's got an underappreciated role. And to sort of elucidate that point, I'm going to be drawing from California, where I live. But I think it's an important state to think about. It's on the front lines of climate change adaptation, with rising sea levels and wildfire. And it's also been on the bleeding edge of climate change mitigation, with sort of higher levels of policy ambition than we're seeing in other states, and even in parts of Europe and the rest of the globe. So I think I'm gonna start with what I think is a non-controversial observation, but I'd be curious in the Q&A if people disagree. From my perspective, I think the most promising path to deep decarbonization runs through the power sector. So the game plan is green the grid, invest in more clean renewables, wind, solar, and electrify a lot of things, from transportation to buildings to some industrial applications. So if we think about taking that path, it's going to require massive capital investment in new electricity generating technologies, supporting infrastructure, grid modernization, charging stations. And it's also going to involve shifting consumers away from natural gas and gasoline towards electricity. So I think the point I want to make today is how we finance this transition is going to determine how much it costs and who pays the price. So it's really exciting when we think about climate action to think about reinventing how we produce electricity and consume it and move it, solar panels and wind turbines and grid modernization and battery storage. Not quite as exciting to think about how we pay for this, and in particular, how we regulate it. But I think it's really important to think about innovation in this space. So my point, if you take anything away from my 20 minutes today, it's that energy rate reform and how we regulate natural monopolies like electricity and natural gas is really going to be key to an equitable and efficient clean energy transition. I'm going to talk in particular about research we're doing that focuses on electricity, but we've got related projects on natural gas and even wildfire insurance, really thinking about how we regulate these natural monopolies and how those regulatory incentives impact how we're responding to the climate challenge. So what I wanted to do today is start with like two very quick slides reminding you of Econ 101 as it pertains to natural monopoly regulations. So for people who took undergraduate economics, hopefully this is a fond memory. If not, I'll just go over the basics, because I think it's important to motivate sort of the fundamental economics of these regulatory questions and challenges before we go to the real world and see how we're actually pricing energy. So I'm going to focus on California and think about both, how the current regulatory regime departs from how an economist would prescribe, and thinking about more of the reinvention and innovation that we could see in energy price regulation. So my point of departure, energy utilities, so electricity, natural gas, are textbook natural monopolies. So they have high fixed capital costs, large economies of scale relative to demand. It doesn't make sense to have many companies running distribution lines down your block. We want to leverage economies of scale and have single or few number of firms supplying the market. But of course, if we're going to create a monopoly, we're also going to need to regulate it to make sure that prices are fair and efficient. So this is a graph showing US utility capital expenditures, electricity and natural gas in recent years, and you can see they're growing, and they're expected to continue to grow. So in this country, in the US and in other countries across the world, you have public utility regulators who are setting the retail rates to allow these utilities to cover their costs and earn an authorized rate of return on their undepreciated assets. So under a linear pricing model, or the simplest possible way we could regulate these utilities, you charge a single price per kilowatt hour or per unit of natural gas, which is set above marginal cost to recover those fixed or sunk costs. Alternatively, you could have a two-part tariff, right? So you could set a price closer to marginal cost and recover additional costs through fixed charges. So if economists call the shots, and we don't at the PUC, we would set electricity rates at social marginal cost, right? So when I run my dishwasher, it uses about a kilowatt hour of electricity. So what does that cost society? It costs us, we got to use the fuel to generate the electricity. There's emissions associated with the generation of that electricity. If I'm running my dishwasher on peak, which I shouldn't be, maybe there was a marginal increase in capital costs for distribution system infrastructure, generation capacity to supply that demand. So we want the consumer to see that social marginal cost so they can make efficient trade-offs. Under a linear pricing, or charging a single price to recover all costs, we're going to see that price is well above social marginal costs in many parts of the country. So what a part of the agenda that I am pursuing and other of my colleagues in energy and environmental economics is to ask the question, how do the electricity prices we see compare to the economist's prescription of setting price equal to social marginal cost? This is a map that I'm taking from a paper that was recently written by two of my colleagues, Severin Bornstein and Jim Bushnell. And what it's showing you is this comparison. How do the average retail price that American consumers pay for their electricity compare to our best estimate of the social marginal cost, what it costs society to incrementally increase electricity consumption and production? And you'll see there are red parts of the country. Those are parts of the country where the prices consumers face are too low relative to social marginal cost. Red in those parts of the country, particularly because in those parts of the country, the grid tends to be less or more carbon intensive. So a kilowatt hour of electricity generates more carbon per unit. I want you to focus on the deep blue parts, and in particular, the state where I live, California. In California, residents, retail consumers are paying prices that are well above the social marginal cost. So we're going to dig into that and sort of think about the implications for the carbon transition, both as it pertains to efficiency and equity. So what I'm showing you here is retail electricity prices, dollars per kilowatt hour paid by retail consumers. And this each bar is showing you the range of retail prices across utilities in the US. And what I've called out in red, green, and yellow are the prices paid by California consumers. And you can see that California prices are consistently above the national average and increasingly out of line with the rest of the country. And this is creating real tensions in California. And again, I'm focusing on California, but I think California is several steps ahead of other states in terms of its climate policies and related activities. So I think there's things to learn from the California case. And in the California case, there is a tension between pursuing our ambitious agenda as it pertains to climate change, adaptation, and mitigation, and our moral obligation to keep energy affordable, particularly for low-income households. So the work that we're doing, which is in progress, we've released a policy paper, and there'll be a more detailed paper out in a couple of months. First, ask the questions, why are rates so high? And the punchline is going to be that costs that are not going forward, incremental costs, are being recovered in a per kilowatt hour rate. Who's paying these prices? Increasingly, it's households who can least afford it. And can we think of alternative rate structures that would improve outcomes both on efficiency and equity grounds? And I think the answer is yes. And I'm going to propose an alternative and invite people to get back to us with their thoughts. But I want to first start by saying we're not, with this research agenda, weighing in on whether these costs are appropriate. I think it's important to keep in mind California is a big state. Our high costs may well be justified in a state that's on the front lines of climate change. The utilities are going to spend over $10 billion in 2021, 2022 in terms of wildfire adaptation, making sure that the grid is more resilient to increasing wildfire risk. So these costs may well be necessary and legitimate costs as we try and make progress with respect to our climate change adaptation and mitigation goals. What I want to focus on is how we're raising the revenues to cover these costs. So the first step we take in our work, and I don't want to dive into the details in this 20-minute presentation, but I think it's interesting to see our best estimate of the social marginal cost of consuming a kilowatt hour of electricity in California. And the number you might want to focus on, this is from my utility, but we looked across California. These marginal costs are coming down because we're greening the grid. The grid is getting cleaner. And our best estimate is in 2019, the average across hours of the year, social marginal cost of consuming electricity was about 8 cents per kilowatt hour. So hold that in your mind. What are we actually paying? So what we're showing is over time, that red line is our best estimate of the social marginal cost, the efficient price that would signal to consumers what it actually costs society to incrementally increase electricity consumption. Households like mine were paying upwards of 25 cents, like more than 3 times the efficient price of electricity. The green line is in California, we have a subsidized electricity price for low-income consumers. So about 23% of California households are eligible for this low-income subsidy. Even those subsidized households are still paying twice our best estimate of the efficient social marginal cost. So what explains that big gap between retail price and social marginal costs? All sorts of costs that don't scale with usage, but that we're recovering in our per kilowatt hour rates. So the legacy costs of building power plants, transmission and distribution investment costs, wildfire mitigation costs, public purpose programs. So in this short presentation, I won't step through every step of this graph, but this is our graphical summary of why am I paying 25 cents a kilowatt hour when the social marginal cost is 8 cents a kilowatt hour. The lower staircase up to the social marginal cost decomposes the social marginal cost into fuel costs, emissions, and what have you. The staircase above the 8 cents is explaining how we get to the retail price. And it's sunk legacy investment costs for generation, transmission, and distribution. That distribution box is capturing some of the wildfire mitigation costs that utilities are having to incur to deal with or to be in the business of supplying electricity across a vast state as wildfire risk escalates. And finally, in the short presentation, I'm not going to spend much time on it, but I do want to highlight the brown box, which is showing you the effect on consumers' electricity prices of how we subsidize rooftop solar. So there's a lively debate in California across the country about net metering. When I put solar panels on my roof, I avoid paying 25 cents, but the true social cost avoided is only 8 cents. So by incentivizing rooftop solar adoption in this way, we are shifting some of that fixed cost recovery obligation away from households like mine with solar on my roof to households who don't have solar on their roofs, and those tend to be lower income consumers. So as you can see, real tensions in California brewing and potentially in other states as we try and sort of reckon with how we're paying for the costs of electricity supply, generation, transportation. So the key takeaway that I hope to leave you with is the way we regulate electric utilities and the way we allow utilities to raise revenues to cover the costs they are incurring effectively taxes electricity consumption to pay for grid modernization, rooftop solar subsidies, climate change adaptation. This has an efficiency implication, right? If we think electrification is a linchpin of our climate mitigation and deep decarbonization strategy, we're putting a barrier in that path by burdening electricity prices with costs that are not going forward incremental expenses of supplying electricity. And there's also an equity element that I think we should have top of mind, particularly given the concern with making sure that the energy transition is an equitable one. So what I'm showing you here is a quick summary of households' response to the Consumer Expenditure Survey in 2017-2018. So I'm focusing on California households, just so we have it's more relevant to the material I've just been discussing. And what I'm summarizing is households' response to questions about income and expenditures. And we've summarized it by income quintile. So 1 is the lowest income, 5 is the highest income category. So for example, that blue line is showing you what you probably already know, which is income is unequally distributed across California households. So the average income reported by the second lowest income category is about 3 times the average income reported by the first. What I want you to focus on though is the green line and how flat that line is, and that's showing you electricity expenditures, right? So although higher income households do consume or spend more on electricity, they spend a much smaller share of their income on electricity as compared to low-income consumers. And that flat line is flatter than the lines that correspond to other consumption goods that are subject to the sales tax. So the punchline from this picture is that raising revenues for climate change mitigation, adaptation, public purpose programs, large investments by taxing electricity is one of the most regressive ways we could raise these revenues, more regressive than an income tax, more regressive than a sales tax. So this leads me to the final point and emphasis of our research agenda and research agendas of others in energy and environmental economics is, can we rethink how we regulate natural monopolies given the efficiency and equity implications of how this is playing out as investment costs escalate in electricity, natural gas, and related industries. And so in our work, we've been sort of thinking about this plight of a policymaker. You're regulating a natural monopoly. You need to guarantee or assure that the natural monopolist can recover the cost of doing its business. So as economists, we want to set the volumetric price equal to social marginal costs so consumers can see what it actually costs to consume electricity. For now, we're going to, today I'm going to focus on a proposal that holds the revenue requirement constant. That is, we continue to assume that we need to recover these costs in electricity rates. I want to make a side point, which is we see a case to be made for taking some of the costs we recover in electricity rates out of the electricity rate base and pushing it onto the state budget. So for example, in California, if you are managing vegetation close to the electricity grid, those are costs that are put in electricity rates. If you're managing vegetation that's far from the electricity grid, that's on the state budget. That's a state cost of adaptation to wildfire risk. So I think we should be potentially revisiting some of the costs we're putting in the rate base, given the equity and efficiency implications of how we're paying for energy. But for our purposes today, and in my last 2 minutes, I want to focus on a proposal that continues to recover the costs we're recovering in rates. But here the aim is to shift some of the cost burden off of lower income households, working within administrative, legal, and political limits that we surely will need to work within in reality. So let's go back to that Natural Monopoly Regulation 101, where I said, one option is linear pricing, which is effectively what we're doing in California and many other states where we recover all the rates in a per kilowatt hour charge. Another is a 2-part tariff that sets the rate per kilowatt hour at the efficient social marginal cost and recovers the remaining costs in a fixed charge. Going back to my utility in 2019, if we all paid 8 cents per kilowatt hour, there'd be a significant chunk of costs we'd still need to recover. If we recovered those in a fixed charge that was equal across all households, it would be a $75 per month fixed charge. But what about if we thought about, well, we can use this rate design feature to try and make cost recovery more equitable. And so what this picture is showing you is, what if fixed charges increased with income in a way that was commensurate with the sales tax, for example? That was the yellow staircase. So here, everyone pays the efficient price. The lowest income households pay no fixed charge. Households like mine pay $150 per household. So this is an alternative way to recover rates that is an improvement on efficiency grounds. We're sending a more efficient price signal. People see what it actually costs to consume more electricity, and improves on equity grounds in terms of shifting more of the cost recovery burden onto households who are in a better position to pay. So in summary, lots of parts of the country, retail electricity prices are set above marginal costs to raise revenues for needed capital investments and legacy costs. These costs are going to escalate. When you look at, no matter which report you're reading, when we think about what it's going to cost to modernize the grid and invest in more renewable energy and the infrastructure we need to support it, these costs are going to increase. The way we currently recover these costs in electricity rates amounts to a regressive tax on energy consumption. This has negative implications for efficiency. It's going to slow, who wants to electrify with electricity prices this high, right? It's going to be harder to get people out of their gas-powered cars into electric cars, swapping their natural gas water heaters for electric water heaters. And it also has equity implications, which need to be front and center as we craft our climate mitigation plans and goals. So, I think an area of innovation that we don't talk about as much as we probably should is thinking about innovating and how we regulate natural monopoly pricing. Changing the way that these escalating sector costs are recovered could help us ensure that the clean energy transition is efficient and equitable. And so as researchers, we're involved in academic research in this space, but we're also part of the policy conversation in California, where I think the tensions are so palpable that people are realizing that we need rate reform of some form. And the conversation is turning to how we can rethink regulating not only electricity prices, but also natural gas prices. Finally, we're also working on property insurance, wildfire insurance, asking similar questions as wildfire risk escalates. How is regulation helping or hindering firms' abilities to change premiums to reflect changing wildfire risk profiles? So I'll stop there and look forward to questions and conversation.
Wonderful. Thank you so much, Meredith. I think you raised a couple of really interesting points, because if we want to make a transition to a low carbon future based on electricity, we need to make sure our electricity grid and regulation energy systems actually can take it. So that's a wonderful point. Great. So our last speaker is Professor Simone Borghesi, who is the director of the Florence School of Regulation, Climate Division at the European University Institute. He's the president-elect of the European Association of Environmental and Resource Economists and the Secretary General of its Policy Outreach Committee. He's also a full professor of economics at the University of Siena in Italy. He has been president of the Italian Association of Environmental and Resource Economists, and he got his PhD at the European University Institute in 2001. He worked at the IMF and FEM Milan, and he was a visiting scholar at INRA, at the University of Cambridge, the ETH Zurich, and he currently also directs the EUI, the Live DICE project on deepening international cooperation on emissions trading, which is especially important given that the EU has been a pioneer in carbon pricing and emissions trading specifically. And he's going to talk about that today and what lessons we can learn from the EU from that. Welcome, Simone, and thank you so much for being here today.
Thank you. It's a great pleasure, great honor to be with you today. As you said, and as the title suggests, I would like to convey some of the lessons that can be learned from the European experience in emission trading system, and also of the research in this area. And for this purpose, I will start by providing an overview of the past and present of the ETS, which I will describe as a living creature. You will see why in a second. And then we'll move on to what I think are the open issues and the next challenges that the EU ETS will have to face in the future. And in particular, I will focus on carbon leakage risk and its possible solutions. And we'll conclude with some lessons. So just to make sure that we are all on the same page, let me start by very briefly describing the functioning of the EU ETS. As you all know, the EU ETS is the cornerstone of the EU climate policy. It's a carbon price mechanism, so it puts a price on greenhouse gas emissions to cost-effectively control and eventually eliminate emissions. It's a cap and trade mechanism. The government sets a cap, a quantity, the total number of emission allowances, and then market operators trade allowances, and the interplay between supply and demand determines the carbon price. Born in 2005, the EU ETS was divided into 4 phases of its increasing length. The pilot phase, 2005-7, then 2008-12, 13-20, and 21-30, the current phase we are in, which covers the whole decade. And while the phases became longer, the stringency also increased over time. The quantity falls by a linear reduction factor that increased over time. It was minus 174% in the period 2013-20, and it was increased up to minus 2.2% from this year. And actually, there is already a plan to further increase the linear reduction factor in the future. The system covers now around 40%, yes, of the European greenhouse gas emissions, more than 10,000 heavy energy using installations, mainly power stations and industrial plants, that are located in 30 countries. But where are these market operators located, and whom do they trade with? Well, to provide an answer to this question, I want to show you a diagram which comes from a paper that I wrote with a colleague, which shows you the EU ETS as a network. Basically, each node in the network corresponds to a country, namely to the set of market operators which open up an account in the national registry of that country. The size of the node is proportional to the in-strength, which is a measure of the incoming links. In other words, the number of allowances that are purchased by the operators in that country. And the color is related to the page rank, which is a measure of network centrality, ranging from blue for low values to red to high values. So, as expected, you can notice that the biggest nodes, the biggest ball in the network, are also more red. Why? Because these countries are more active in the network and therefore are also more central in the network. However, this is not always the case. If you compare Netherlands and Spain, for instance, you notice that they have similar size but different colors, Netherlands being much more central. Indeed, the centrality does not depend only on how active you are in the market, but also on whom do you trade with. So if you trade with other countries that are very central in the network, you become central as well. Indeed, from this visual representation, you can notice that there are 5 countries that emerge as particularly key in the network, namely France, Germany, Great Britain, UK, Denmark, and the Netherlands. Obviously, this was a representation based on the first phases. But we all know that with Brexit, things changed. And so the question that I wanted to address is what happens if we take out the UK red ball? How things will change with Brexit? For this reason, we, with the same colleague, we wrote a follow-up paper, I would say, entitled With or Without UK, in which you look at the structure after Brexit. What could be the impact of Brexit on the direction and flows of the transactions? And we try to provide different scenarios depending on the possible reallocation of the transactions that involve the UK partners. What we find, obviously, is based on backward analysis, because we don't have, due to the embargo on the data, the real-time data. But what we have based on the past is that we can expect the network to become more homogeneous because of the reallocation of the transaction from the UK to the other countries, but still characterized by a core periphery structure in which a few large nodes remain and the others are at the periphery, at the margin of the network. As this analysis shows, the structure of the ETS or the EU ETS changes over time, a sort of a living creature. And indeed, the more I study this topic, the more I see the EU ETS as a living creature. As a living creature, it comes to life, grows, learns, and teaches, and sometimes it gets married, like in the case of the linking with Switzerland, or divorce, like in the case of Brexit. As I said, it came to life in 2005, and from the very beginning, it was clear that it was one of a kind, the first transboundary cap and trade system, and the world's largest carbon market, at least until the Chinese market will become truly operational. From the very beginning, the system started growing, adding new sectors, petrochemical, aluminium, ammonia, and gases, nitrous oxide and perfluorocarbons under the ETS. And as we will see in a second, it keeps growing and adding new sectors. And as it was growing, it was also learning. And the learning was actually a continuous learning process, as witnessed by the number of reforms the EU ETS went through. After the initial 2003 directive, there was a revision, a new directive in 2005. Then in 2014, the backloading, a short-term intervention to reduce market imbalance. The market stability reserve in 2019, a long-term intervention aimed at stabilizing the market with predefined automatic supply changes. The revision for phase 4, and currently the 2021 review under the Fit for 55 measures. Not only the UTS learned, but also has also been teaching to the others. It has been a pioneer and often considered as a prototype for all its followers. And the followers has been quite many. This image from ICAP shows the extension of the ETSs around the world. In blue, you have the jurisdictions that adopted an ETS. In green, those where the ETS is under development, and in yellow, those where it is under consideration. And as you see, starting from Europe, ETSs extended, spread to Quebec, Reggie on the eastern coast of the US, California, Mexico, but also eastern to Kazakhstan, South Korea, New Zealand, and last but not least, China, with its 7 pilot projects and with the nationwide ETS that is growing, has been just born. Each ETS has its own structure, has its own rules, has its own applications. For this reason, we wanted to see how the systems can be aligned. And this is the object of the project that I'm currently directing at the European University Institute, namely the Life DICET project, where the Latin acronym DICET stands for Deepening International Cooperation on Emissions Trading. The project involves the regulators of the main ETSs around the world, Europe, California, China, New Zealand, Quebec, and Switzerland, with the objective of aligning these ETSs and possible integrate them in a larger, maybe in a future global carbon markets. Each ETS has its own story, and as any living creature, also the ETS had its ups and downs, which are here well represented by the carbon price intertemporal trend. The diagram shows the trend of carbon price in Europe from the beginning of phase 2 up to basically today. And as you see, you can easily read the financial crisis, 2007 2008, which caused a fall in price. Prices remain very low, below 5 euros per ton of CO2 for a long time, until the end of 2017, when the announcement of the Market Stability Reserve and of a more stringent intervention by the regulator led to a new rise in price, which continued despite the pandemic crisis, despite the lockdown. And the price is now above 60 euros per ton of CO2. I think yesterday was 58 something. A similar trend can be observed also in the other major ETSs. New Zealand, the line in green, California and Quebec, which linked their ETSs in 2014, so they continue with just one price, one line, and Switzerland, which joined the ETS at the beginning of 2020, and so its price is rapidly converging to the European one. If you look at these trends, you notice that they are somehow similar, but there are still large differences in terms of carbon prices, with the carbon price in Europe being much higher, almost 50% higher than in New Zealand, and almost 3 times higher than in California and Quebec. And this difference is even larger if you look at the Chinese pilot projects, which show large fluctuations because they are all in their infancy, if you want, but with prices that are all around $5 per ton of CO2, only Beijing being above 10. So large differences. So what we have is an increasing price in Europe and increasing gap with respect to the other ETSs. This brings me to what, in my view, are the next challenges. Namely, this trend may provoke concerns in terms of competitiveness for European firms and distributional concerns because of the possible regressive effects of the increasing carbon prices. In my view, these are the 2 major challenges that the ETS will have to face in the future, together with those that come from its continuous growth, the extension to new sectors, the maritime, which is about to enter the current ETS, and the buildings and transports that are planning to set their own ETS in the next few years, hopefully and possibly converging with the EU ETS in the future. Now, due to time constraints, I want to focus on one of these aspects. I will focus only on the first one, on the competitiveness issue, and on the possible risk of carbon leakage. We all know that unilateral policies like the ETS may provoke carbon leakage, namely the delocalization of the polluting activities. To be honest, so far, the literature shows very little of no evidence of carbon leakage. No evidence in the Schillepret and other study, a very weak evidence, for instance, in a study on German firms by Koch and Bassemama, or in another study that I conducted with Chiara Franco and Giovanni Marin on Italian firms. But this is true, or these studies were based, including mine, on a previous period when carbon prices were low, as we saw. What will happen if carbon prices keep rising, as we can expect if we want to achieve climate neutrality by 2050 or by 2060 in the case of China? So this raises the issue of how to safeguard international competitiveness. And in my view, there are 3 possible ways. The most commonly adopted way is free allowance allocation. This has been adopted in mainly all ETSs, with free allowances to installations of sectors at risk of carbon leakage. However, here the problem is how to define the sectors at risk of carbon leakage, and what is the optimal level of allocation that we should give. According to some studies, for instance, Martin and others, these criteria were too generous in Europe, which led, especially at the beginning, to windfall profits and reduced incentive to innovation. For this reason, the European Commission is planning to phase out free allowances and looking for alternative solutions. And one of these is certainly linking. This is the object of the Life Ditches project. Linking leads to price convergence across the linked ETSs. So it reduces automatically the incentive to delocalize to the other jurisdictions. However, the problem is how to align the various ETSs. What, for instance, is the maximum price differential for prospective linking? What's the maximum size differential? Or which are the features that may prevent linking? For instance, how can we link a system that has an absolute cap with one that have a relative cap, like the Chinese one? These and other questions are the object of our project. Linking, in my view, is an interesting perspective, but it takes time because it needs to build up mutual trust, and this takes time. And since we don't have much time, given the urgency of many climate problems, Europe is looking for an alternative solution. And this is how the carbon border adjustment mechanism came about. Certainly, it is a reasonable mechanism because it tries to create a level playing field. However, the problem here are how to implement it, how to avoid possible retaliation problems, because in my view, we should avoid absolutely trade wars and beggar thy neighbor policies, especially in a period of recession or pandemic like the present one. As you notice, all these solutions to safeguard international competitiveness imply strategic component across, or better, between the regulator and the firms, across ETSs or across countries. For this reason, I think it is very useful to adopt a game theoretical approach. And this is what we try to do with some colleagues in a paper entitled Should I Stay or Should I Go?, in which we consider a set of firms that have to decide whether to stay or delocalize, and in which their decision depends on what the others do. So we introduce the possibility of mimicking the other, imitation processes. And when we do that, the design of the ETS affects the share of firms that are delocalizing, creating interesting nonlinear effects. I don't have the time to discuss this in further details, but I just leave you the link in case you want to access the paper, actually freely accessible until the end of November. Now, I think my time is getting to the end, so let me use the few last minutes to discuss the lessons that, in my view, emerge from the European experience. First of all, research lessons. There is large room for more research in game theory, in network studies, in empirical analysis, obviously. So different instruments that can help understand more for the future. Secondly, policy lessons. I think for policymakers, one of the lessons is that emission trading systems are a living creature. So the EU ETS is a living creature, but also the other ETSs. In this sense, they go through a continuous learning process. And obviously for economists, credible commitments are of key importance. And this is very clear when we look at the effects that the announcement of the Market Stability Reserve of the European Green Deal had on the European carbon price. Higher stringency led to higher carbon prices as expected. On the one hand, this can have a higher impact on firms and households, which raises a problem of social acceptability for the future, which I think is very important, and I'm happy to discuss it further in the Q&A. On the other hand, higher carbon prices imply a larger incentive to innovation, larger incentive to behavioral changes, and also larger auction revenues, more than 57 billion euros in the period 12-20. The use of these revenues, in my view, is of key importance to mitigate losses and to fund low carbon innovations through the Innovation Fund or the Modernization Fund. So much of the success of the EU ETS in the future will depend on how the auction revenues will be used. Finally, the title was a bit patronizing in my view, Lessons from Europe. To be honest, I think there are lessons to be learned from Europe and lessons to Europe, so in a mutual learning process. For instance, California-Quebec linking was an interesting lesson for the linking agreement that the EU has then or it wants to establish in the future. And also the floor price, which is missing in Europe, could be a lesson to think about for the future. And finally, the CBAM itself can be a lesson in both directions. It can be a lesson for the others if the others will follow the European example. But in any case, we can expect that Europe will have to learn from the other, adapt to the other, and interact with its trade partners if it wants the CBAM to work. And on this note, I think I will stop here and leave room to your questions and discussion. Thank you.
Great, thank you so much, Simone. That was very interesting, especially given that the EU has been really a pioneer in climate policy and in carbon pricing. So I'd love for all of you to unmute, please, and we're going to talk about different questions that we got from the audience, and also kind of like that arose in the terms of your presentation. I want to start with Simone. Can you talk a little bit about the carbon border adjustment tax that is being discussed in Europe? What are some of the latest developments that you see? How likely it is that it will come, and what form will it take?
Well, that's a very good question. I remember discussing this point a few months ago with Robert Stavins, who told me, are you kidding me? Are you sure that Europe is going to do that? Well, let me say how I see this. It's a very risky move, I must admit, but at the same time, it's a game changer, which somehow pushes things and speed up the process. I think that's the intention that Europe has in this case. Whether right or wrong, I think it's producing some effects, because I'm reading on the news that Russia start thinking about a carbon tax. I'm reading on the news that the US is changing attitude. Actually, to be honest, the US already had thought about a CBAM in the past. So Canada is considering that. So, somehow it creates the structure for a carbon club or carbon coalition, whatever you want to call it, of the kind that probably Nordhaus had in mind years ago. So it can help pushing things ahead, or it can be just an instrument to go on. I mean, I have the impression that Europe maybe doesn't want to use it at all. And it's just a strategic move. Obviously, I can't tell. It's just my impression.
Of course, yeah.
But certainly, the great challenge is how to make it WTO compatible.
Yeah.
And I think Europe is moving in the right direction, to be honest, involving its trading partners in a dialogue before implementing any CBAM, because the CBAM is going to implement it, if any, in 2026, say. So, I mean, there is time to think about it, and also excluding export rebates, which was probably one of the most critical aspects in the original proposal.
And I think you're right. I mean, I think it's a really important signal, right? Especially a signal towards markets like the US that have for years failed to implement any kind of carbon price. Meredith, I'd love if you can weigh in a little bit on that, because I think there has been some thinking on this in California, right?
Yeah, so California has a border carbon adjustment, like a real live border carbon adjustment, which I think not everybody appreciates. And I think there are some interesting lessons to learn from it briefly. So it's only in electricity.
Okay.
When the cap and trade program was set up, a majority of the emissions from electricity consumption in California came from outside. So it was clear that something needed to be done. So how it works is we tax emissions in California directly and then effectively sort of stand on the border and try and price the carbon that's baked into electricity imports. And I just want to pick up on something Simone said. So what I think the lesson that is most interesting to me is it really elucidates a tension between needing to be careful about protectionism or perceived protectionism, because you could just the original plan was to stand on the border and just charge an emissions rate.
Right.
But when that emissions rate is not zero, that means a wind turbine in Nevada is not happy because a wind turbine in California faces no compliance charge, whereas a wind turbine in Nevada is being penalized by this average rate. So what California did was set an average rate, but allow outside zero carbon resources to opt out and demonstrate that they're zero carbon. The problem there is it does not solve the leakage problem because there's enough out-of-state zero carbon resources such that we're seeing reshuffling. All the zero carbon resources are being put on paper, sent to California, but we're not shutting down coal plants. We're just rearranging supply relationships. And so our research has been a little bit, I mean, I think it's important. It's a really important proof of concept. You know, it's showing some of the real world complexities of implementing this, and also showing that this is a difficult challenge to strike a balance between WTO agreements or concerns about trade protectionism and really mitigating the leakage problem. So it's a work in progress and one worth watching as we try and learn from the experiences of other jurisdictions.
And I think you raise a very important point, which is kind of like the fine line between protectionism and doing the carbon border adjustment, because I think we see a lot of proposals now in the current negotiations in Congress to put a carbon border adjustment tax in the US without having a domestic carbon price. And that doesn't make any sense. It's going to be very difficult to ascertain the proper price. And as a signal, it's very difficult, right? To say, oh, we have this bunch of regulations, and based on that, we indirectly calculate a carbon price, a carbon border adjustment tax, and we don't have a carbon price. So I'd like to stay on Meredith. I want to talk a little bit about California has started to experiment already many years ago with some hydrogen-powered cars. And so I was wondering, do you know a little bit about what the thinking is on hydrogen combined with electricity? Is there any new developments that you have seen?
I'm afraid I don't know. That's something I don't know much about. I mean, I know that there's probably, there is some policy in place there. What I'm more familiar, there's a real push towards electric cars and the kinds of infrastructure investments one would need to help, you know, convince consumers out of the gas-powered cars. But unfortunately, I have not been following the hydrogen-powered car development.
No problem. Let's move on to Johannes. So we got a question from the audience, which is on kind of like the securities markets, and especially in the mortgage space. So what do you think, what are some of the frameworks that are being used to price climate risk in those security markets, and especially in the mortgage space? And I'm curious, because in your presentation, you mentioned kind of like a lot of those assets don't price the climate risk in yet. What is your expected time frame that investors, that kind of like market actors will start to price it in actually?
Yeah, I mean, so in particular for mortgage-backed securities, which I think are the largest sort of group of of assets that trade, that have the mortgage markets in the background. One of the challenge to pricing climate risk there is that the largest part of the U.S. mortgage market, as you know, is these government or government-sponsored enterprises, Fannie Mae and Freddie Mac, guaranteeing the default risk on these mortgages. And if you think that the fundamental way in which climate risk is priced in mortgage markets, it would come through default risk pricing. And so if your property gets flooded, that makes it much less likely that you'll repay the mortgage. And those and so we see that there is a lot of that sort of guarantee being exploited by mortgage lenders. So for example, there's research that shows that if you're a bank and you originate mortgages, if you become more worried about climate risks, you're actually more likely to send those mortgages and package them in precisely these GSE insured mortgage-backed securities. So it's shifting of the risk essentially to the government. And the big problem there is that the government isn't pricing this risk. So the G fee, which is this fee that Fannie Mae and Freddie Mac receive for taking this default risk out of these mortgage-backed securities, is constant across space. So it doesn't vary between, say, a coastal property in Florida, which is likely to be flooded in 40, 50 years from now, versus somewhere that is not. And that has got, a lot of historical reasons. There's a lot of good reasons for that. The mortgage market is one where historically we've seen a lot of redlining, where minority neighborhoods would pay substantially higher mortgage rates. It was impossible to get mortgages there at all. And so historically, the government is, the GSEs have been very averse to having any spatial price differences in that default guarantee. But what it means is that this is not a risk that ends up being priced in the market, but it is a risk that sort of in a hidden way is getting transferred to the taxpayer that is eventually responsible for for those guarantees. And so that means in that sort of largest part of the mortgage market, the risk isn't priced, but it comes in there's a huge implied government subsidy to sort of areas with more climate risk exposure. In private mortgage-backed securities markets, you can start seeing it being priced a little already today. And so now then where the question, over what horizon do we think it'll be fully priced? That's a really hard question, because it requires you to take a stand not just on an asset pricing model, but it also requires you to take a stand on what you think the future path of carbon emissions is. There's a lot of uncertainty, a lot of paths regulation can go. You then need to make an assumption how those carbon emissions will translate into global temperatures. You need to make an assumption about how those global temperature changes will lead to, rising sea levels, flooding, et cetera, and then only then does asset pricing start playing a role. You can then try and figure out, how we're going to price these risks. And so there's an enormous amount of uncertainty there. What we can say is it is being priced already the same way that it's being priced in real estate markets. But, is it being priced adequately? It's always adequate relative to my model of where regulation is going to go, and then all these physical feedback loops about how that regulation translates to climate and rising sea levels. And that's just, the error bands around each of these steps is just so wide that I don't think I can credibly say, I think, it's adequately priced, overpriced, or underpriced.
That's actually really interesting. I'd love to turn to Meredith. You have done some work on insurance markets as well in California, right? Can you tell us some lessons learned or some of the impact that you have seen?
I can't tell you lessons learned yet, but I can tell you questions asked. And listening to Johannes, I guess I would be curious. So one thing we've become interested in is regulation of property insurance and homeowners insurance in particular. And something that caught our attention is, Johannes, you were talking about these, probabilistic models, and there's tremendous innovation in that space, really trying to improve our read on current risk profiles and where we're going. One thing that caught our attention is that the California Department of Insurance regulator, very apprehensive to allow insurance companies, the state farms, the Allstates, to base their premia on these probabilistic models, because they're trying to balance transparency and concerns about firms using these very hard to understand models to rationalize different pricing across properties and across parcels, against the very clear need for firms to signal the real risk, the changing risk. And so right now, as the regulations are written, when a firm wants to apply to change its premia that it's charging different types of parcels, it can only use backward-looking data from its own portfolios. And it seems that this could be the question is, how important is that regulatory limitation? Is that limiting firms' ability to leverage innovation in the modeling space to send better signals to homeowners that this is a risky property and this is not? So empirically, we're just trying to better understand the relationship between our best modeling of risks and how the premia vary across parcels with different risks. So I don't know if there are parallels with what you're working on, Johannes, but it struck us that this regulation could be impeding potentially firms' ability to respond and price risk.
No, I think that's extremely likely, and it'd be interesting to see sort of when you end up quantifying it, how big that is. There for these types of climate risk property insurance, I mean, the market for flood insurance, the private market, has broken down a long time ago, and so we have the National Flood Insurance Program, which, by the way, is the exact same cross-subsidy issues as the G-fee, right? And that's something that's actually on the table right now to be changed. So we're having discussions, as we speak, about whether or not over the next 20, 30 years, these flood insurance rates from the National Flood Insurance Program will start to approximate more the actuarially fair rates. The problem is that there's going to be properties where that will go up from a few $100s a year to more than $10,000 a year, which will make it essentially unaffordable to live in some of these coastal communities. Now, honestly, my view is that's probably where we need to go. It is probably in the long run unsustainable to live in these communities, and price signals might be a great way to tell people to stop moving there already, so that by the time that these sort of sea level rises, etc., materialize, you're starting to you have much less capital deployed there. You have many fewer people living there. But we're seeing the exact same issues with the wildfire market. I think wildfire insurance, which I think is one that in California right now is a big deal, where insurance companies are realizing their models, in particular the models trained on past data, have sort of meant that the types of fires we've seen the last few years have all been 1 in 100-year events, or whatever the exact number is. And so you need to start using these more forward-looking models. I think part of the question is the pricing that those models apply. Are those are they essentially rates that no one can end up affording? So I think there's a danger that the wildfire insurance will go the way that national flood insurance, the flood insurance will go, where essentially in the absence of a heavy taxpayer subsidy, some of these properties just become unaffordable. So it'll be interesting to get a sense quantitatively where that ends up, and how many properties will end up being in this essentially uninsurable space. I don't know if you've had a chance to look at that
yet.
Yeah,
I mean, I guess the only other thing I want to inject in this conversation, which is really interesting, is there are several things that homeowners can do to protect their home in terms of defensible space and building materials. And so something that I think is very exciting, but still I think limited in this current regime, is you can imagine, and you're starting to see some experimentation, your premiums will be lower if your community can get together and solve this coordination problem, and everyone takes the steps that they need to take such that when the fire comes, we can defend your space. And so right now there's a limited ability, but that's a really important margin that homeowners do not have an incentive to invest in. But if you could figure out how to convey that through adjusted premiums, I think it could be powerful. So one thing I should mention, and I think what you put your finger on, Johannes, is there's a real equity affordability concern about, if people are living in places that are going to become inhabitable, what do you do? Especially in California, where affordability in the urban areas have pushed people out into the wilderness interface, which is precisely where the risk is high. So we do have a FAIR plan that is sort of a backstop so that people get pushed off. But it's just thinking about how to strike that appropriate balance between setting the right price signals and making sure that people who are, really marginalized aren't impacted too hard.
And I think the problem is, and I agree with you, Johannes, I think that is a very hard conversation to have, to say certain areas are maybe off limits for zoning or should not be rebuilt. But at the end of the day, someone will have to foot the bill, right? Currently, it's mostly taxpayers if something happens, right? And so we have to, I think, even reconsider what kind of areas we want to build in. And I think we've seen that in Houston play out in the debate there, like which areas should be up for zoning and which shouldn't. I want to move over to you, Simone, a little bit on a question that is slightly related, but you showed in one of your graphs, effectively the EU has one of the highest carbon prices now in the world, right? And it's rising. It's been rising quite fast actually over the last couple of months. And so you pointed out kind of what's going to happen if it rises further. The EU is really, I think, if you look around the world, the one bloc that has credibly committed to really reducing emissions and to doing something about it, much more so than most other areas. And we've seen some pushback, not too much, but some pushback in the population. So my question is kind of like, it came from the audience actually. How can the EU kind of like maintain their quality of life and still become carbon neutral? And what's the best way to go about that? And the second part of the question is, have you seen, and to what degree have you seen the EU ETS being kind of like a template for other programs around the world, and the EU really with a leadership role influencing policies in other parts of the world, especially the developing world?
Okay, thank you. That's an interesting question that I think Europeans are asking themselves right now in a way. It is true that there has been some pushback, but I think the framework that Europe is building tries to address these distributional aspects. I mean, the way to go, in my view, is redistribution, to make sure that the climate issue does not become an equity issue. I mean, building up on what Meredith was saying, because I think that's very true. That's a big risk that would pose everything at risk, the whole structure at risk. But, you know, Europe has also done steps in the right direction, in my view. For instance, building up this social climate fund for the redistribution of the revenues coming from the ETSs. Also, that is from building and transport ETSs, but now they're planning to do it also more and more with the EU ETS that we have already. So work more on the redistribution of the revenues, and consider that the revenues from the auctioning will be higher if prices get higher and higher. So there is a larger amount of money that can be redistributed. So we should not deny the possible regressive effects of some measures, but we should communicate to the population that, look, we are doing something, and this is the something we are doing. These are the money that we use for the redistribution to make sure that people are compensated. And consider the second question on the leadership of the EU. Well, if you think about it, the EU is producing 9% of global emissions. And the EU ETS covers around 40% of European emissions. So it's less than 5% of global emissions. So if you think about it, it's a tiny little contribution.
Right.
But I think it has, in reality, an important signal effect. And it's an important contribution as long as Europe manages to have a leadership role. My feeling, you know, from the perspective of EOI and of the project we carry forward, is that it is working. It is producing effects on the others. And so I think Europe has built a leadership, taking advantage in a way of a period in which the US leadership was lower. Unfortunately, I mean, the climate topic is on the agenda again in the US. So yes, I think the signaling effect is even more important than actual emissions reduction that we can achieve in Europe alone, because in the end we will achieve global targets only through a global action.
I agree. That's actually a good point. So we have a few more minutes. I wanna close with one question to all panelists that also came from the audience. We currently have the negotiations ongoing in Congress about the reconciliation bill, where a carbon price is being considered. But the US has a very kind of like spotted history with a federal carbon price. We don't have one. It failed a couple of times. So if you had to kind of like identify the largest obstacle or the way to get a carbon price passed at the federal level in the US, how do you think that that would be the most efficient or the easiest way to go about? This is obviously not a very easy question, as you can see. So Meredith, you want to start?
Oh boy. I mean, I think one of the problems has been when you talk about a carbon tax, you're leading with the pain, the cost, and you're sort of, it's playing in the background is the benefit, the carbon mitigation.
That's true.
So, you know, especially as we're pushing for deep decarbonization, I think we could think creatively and say, okay, let's make it a renewable energy standard that mimics the carbon tax more so than the plan that was on the table.
Interesting.
But you can lead with renewable energy, which when you poll people, you know, people like the idea, as they should. It's, you know, the costs are coming down. So I think part of it will be just how you present it, and leading with the shiny object and not focusing as much attention on the fact that we're going to have to pay for it. But if crafted well, we can mitigate that price tag.
Yeah.
Seems to be sort of but I'm not a politician, I'm an economist. So, but that would be my take.
Great, thank you. Johannes, your thoughts on this?
I mean, my thought is sort of related. You know, I think the first thing is you stop calling it a carbon tax and you start and you start talking about a carbon dividend. Right, because yes, it is going to cost us something, but you can make this revenue neutral, and you can probably make this pretty progressive. I suspect, you know, if you go the way that you know some parts of the world have done, and basically just redistribute this either lump sum or even in a sort of, you know, a progressive way. a large part of the population will end up being better off. And so, tax always sounds like you're going to have less money in your pocket at the end of the day. Yeah. And, yes, you don't want to pay more at the pump. But in the end, if that comes with a $2,000 check from the government every year, some sort of refundable tax credit of some sorts, I think you could get a lot of people on board that way. So start talking about the carbon dividend that comes and less about the tax.
I think that's a great point. And I've seen models around the world where parties from the right and the left came to an arrangement through that. So kind of like making it carbon neutral and maybe combining it with some kind of corporate income tax reform. Simone is an outsider. What are your thoughts on this?
Well, it's even more difficult from the outside, but I can just echo what Meredith and Johannes said, and insist on the communication part. In the end, that's what they are also saying. Don't present it as a tax. This is definitely not the way to go. But actually, there was already a statement by many Nobel Prizes and US economists and economists from all over the world insisting on the carbon dividend idea that Johannes was suggesting. I think that's the right way to go. And on top of that, I think earmarking the revenues could be an important way to go, so that people really see where the money go. I know that this is controversial from a theoretical viewpoint, but I think that this is how it works, how it should work, how you can get people on board.
To get a broad coalition. Well, this has been really interesting, and I want to thank all three of you for taking the time. I know you're incredibly busy, but I think that was a super helpful and very interesting discussion today. Thank you again, and all the best.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.